What if I told you that most millionaires don't become rich by earning a massive salary? They don't necessarily have the highest paying jobs. They don't all inherit fortunes. And they certainly don't all get rich overnight. In fact, the way many millionaires build wealth is surprisingly simple. They buy things that make money. Then they keep buying more. A salary can make you comfortable, but ownership can make you wealthy. And this distinction changes everything. Imagine two people. The first earns $200,000 a year. The second earns $100,000. At first, the first person looks richer. But suppose the second person owns a business worth $2 million, has investment accounts generating returns, and owns several properties. Suddenly, the income comparison doesn't matter. Because wealth isn't simply about how much money comes in, it's about what you own when the money stops coming in. The Federal Reserve's household data shows that income can come from wages and self-employment, but also from interest, dividends, and rental income. And that reveals the first secret. Millionaires don't just chase income, they build assets. So how exactly do they do it? Let's break it down. Level 1. They turn income into assets. The first level is the most boring, and that's exactly why most people ignore it. Millionaires often start the same way everyone else does. They work, they earn, they save. But then they do something different. They don't allow all of their income to disappear into consumption. They convert part of it into assets, stocks, real estate, businesses, retirement accounts, intellectual property, and other investments. Think about it. You earn $5,000. You can spend the entire $5,000, or you can spend $4,000 and use $1,000 to buy something that could produce more money later. That $1,000 isn't simply money anymore. It's capital. And capital has a special ability. It can work without you. This is where compound growth enters the story. Suppose someone invests $1,000 every month for decades. The early years may look unimpressive, but eventually the investment returns. Themselves begin generating returns. Your money starts making money. Then that money makes more money. And the cycle accelerates. This is why becoming wealthy often looks slow in the beginning, then suddenly looks fast. A person earning $100,000 with a high savings rate and decades of investing can potentially build enormous wealth. Meanwhile, someone earning $300,000 but spending $290,000 every year may remain financially fragile. The lesson? Income starts the engine. Assets keep it running. Level 2. They own businesses. Now we move to the next level. And this is where the wealth equation becomes much more interesting. A job pays you for your time. A business can pay you for creating a system. That's a completely different model. Imagine you run a small restaurant. You work 8 hours. You make money. But if you open a second location, your income isn't necessarily limited to the hours you personally work. You have employees, systems, suppliers, technology, brand recognition, customers. The business becomes an economic machine, and eventually, that machine itself can become valuable. This is why business ownership appears so frequently among wealthy households. Federal Reserve data has found that business ownership rises with income. In its 2019 survey of consumer finances, nearly 40% of families in the top income decile owned a business. And there's another fascinating detail. Businesses with 5 or more employees had average business equity of roughly $4.1 million in that survey, compared with about $447,000 for businesses with fewer than 5 employees. The point isn't that everyone should start a company. It's that ownership creates something a salary usually doesn't: equity. If your company grows, your ownership stake can become more valuable. And you don't necessarily need to build the next Amazon. A cleaning company, a logistics business, a construction company, a software company, a medical practice, a manufacturing business, even a small profitable company can become an asset. The millionaire mindset is therefore not simply, how much can I earn? It's, what can I own? Level 3. They let compounding do the heavy lifting. Here's where the story gets even more powerful. Millionaires understand something most people learn too late. You don't always need to find the next explosive investment. Sometimes you simply need to stay invested long enough. Consider an investor who puts money into diversified assets and continues contributing year after year. There will be crashes, recessions, bad headlines, market bubbles, political uncertainty. But if the underlying assets continue growing over decades, time becomes an enormous advantage. This is the boring side of wealth. And boring is powerful, because $1 million portfolio doesn't necessarily come from one spectacular investment. It can come from thousands of small decisions repeated for decades. Invest, reinvest, wait, invest again. The Federal Reserve's financial data shows just how important asset ownership becomes at higher wealth levels. In the first quarter of 2026, households in the 90th to 99th wealth percentiles held about 37.2% of aggregate corporate equities and mutual fund shares. That's the key. When stocks rise, owners participate. When companies grow, shareholders participate. When profits are distributed, investors can participate. The worker receives a paycheck, the owner participates in the growth of the asset, and that distinction becomes enormous over time. This is also why patience is such an underrated financial skill. Someone who invests for 30 years doesn't need to predict every market movement. They need to avoid destroying their strategy. They need to keep contributing, and they need to give compounding time to work. Because wealth often isn't built by doing something extraordinary once. It's built by doing ordinary things for an extraordinary amount of time. Level 4. They use real estate and leverage. Now we reach one of the most controversial tools of wealth creation: debt. Used badly, debt can destroy you. Used carefully, it can become leverage. Real estate provides one of the clearest examples. Imagine buying a property with a mortgage. You don't provide 100% of the purchase price. The bank finances part of the asset. You provide the remaining capital. If the property appreciates over time, your equity can grow. Meanwhile, tenants may help cover the property's operating costs and financing. But there is an important warning. Leverage works both ways. If the property falls sharply in value, your losses can be magnified relative to the money you originally invested. This is why wealthy investors don't simply ask, "Can I borrow the money?" They ask, "Can this asset safely support the debt?" That's a completely different question. Real estate can also produce multiple forms of return: rental income, potential appreciation, tax advantages, depending on the jurisdiction, and equity accumulation as debt is paid down. But there's another reason property matters. People understand it. They can see it. They can touch it. And for many households, a home becomes one of their largest assets. The important lesson isn't buy as many houses as possible. It's understanding leverage. Use capital intelligently. Don't let borrowed money control you. Level 5. They build multiple engines of wealth. Now comes the biggest reveal. Millionaires don't necessarily have one secret source of money. They often have multiple engines working simultaneously. A salary, a business, a retirement account, stocks, real estate, royalties, consulting income, dividends, interest. The power isn't necessarily in any single one. It's in the combination. Imagine someone earns $150,000 from a career. They invest $30,000. They own a small business that produces another $40,000. Their investments generate additional returns. Their property produces rental income. Now, their financial life isn't dependent on one paycheck. That's the transformation. At the beginning, you work for money. Eventually, you want money working alongside you. The Federal Reserve's latest household data illustrates this transition. In 2025, 37% of adults reported receiving interest, dividend, or rental income, while 57% received some form of non-labor income. But there's an even deeper psychological shift. Millionaires often stop asking, "What can I afford?" and start asking, "What can I acquire that might produce value?" A luxury car consumes money. A productive asset can potentially generate it. A vacation creates memories. A business can create cash flow. A designer watch may hold some value. An investment portfolio can potentially compound. This doesn't mean wealthy people never spend money. They absolutely do. The difference is that wealth becomes easier to sustain when consumption is funded by productive assets, rather than constantly draining the capital base. That's why the real game isn't simply becoming a millionaire. It's becoming someone who owns enough productive assets that their lifestyle doesn't depend entirely on their labor. Conclusion: the real secret. So how do millionaires make their money? There isn't one answer. Some build businesses, some become highly paid professionals. Some invest, some buy real estate, some inherit wealth, some combine several strategies. But underneath all these stories is a common principle: ownership. They convert income into assets. They accumulate equity, they reinvest, they use time, they manage risk, and they allow productive assets to compound. That's why two people with identical salaries can end up with completely different financial futures. One spends every raise, the other invests it. One buys liabilities, the other buys assets. One focuses entirely on income, and the other focuses on income and ownership. And after 20 or 30 years, the difference can become enormous. The most important question isn't, how can I make more money? It's, how can I turn the money I make into something that makes more money? Because a paycheck can change your lifestyle, but ownership can change your financial trajectory. And that may be the closest thing to a real millionaire formula. Earn, save, buy assets, build ownership, reinvest, wait. Then let time do what time does best. Multiply the results. The wealthy don't necessarily have a completely different world. They simply tend to own more of the things that produce value inside it. And once you understand that, you stop looking at money as something to spend. You start looking at it as something to deploy. And that's when the game changes.